All right. Hey, everyone. Welcome to Birgo Capital's live session on principles over predictions. We're going to talk a little bit today about common sense strategies for uncommon times. The reality is, you're seeing lots of hype right now. So, tech manias, AI memes, that stuff's catching the headlines. But you're also probably seeing a little bit about supply shocks, geopolitical tension, really ballooning debt, global debt ballooning. And you might be asking yourself the question, how does this relate to my investment strategy? How does this relate to my capital? So that's what we're going to talk about today. We're going to do that through the lens of what we believe we're subject matter experts in, which is real estate. But we believe these principles are universally relevant. So, without further ado, let's go ahead and jump in. Um, so, who are we? We are Andrew and Josh. Super excited to be with you. I'm Andrew Riker. I'm co founder of Birgo Capital and CEO. Actually, a little over 15 years experience in real estate investing and operations. Prior to that, I was in banking, development, technology, really cut my teeth on lending and underwriting in my early days with a regional bank here in Pittsburgh called PNC Bank, and founded this company back in 2012. So since then, been full time kind of doing the real estate investing thing.
I'm Josh Fisher. I'm our managing director of capital markets with Birgo Capital. I have successfully sourced and closed on just over $450 million of investment property with us. I really spent my whole career in real estate, so I've got experience in negotiations and investment analysis and really full capital stack formation.
Yeah, awesome. Well, really excited to dig in today. So, first of all, let's talk about where are we in history. So, I believe we're at kind of a pivotal point in history. If I'm just looking at the macro backdrop, there's a lot of really interesting trends happening right now. First of all, again, founded this back in 2012, and really there's been an era of what I would call easy money for like a decade. And that is no longer. So while there's Fed rate cuts on the horizon, in fact, we're doing this live on September 9th, September 17th, fingers crossed, maybe a rate cut. I'll be watching the news, ready to see what's happening. But the reality is long-term yields have just structurally shifted higher. So we're seeing that that's a reality of where we are today. And then along those lines, in terms of other kind of things that are happening, global debt is really at an unsustainable level. $350 trillion of global debt. And it's continuing to rise. And the US is refinancing more than $500 billion weekly. So there are really these huge debt bubbles all over the world that people are just kind of asking, when is that bubble going to pop? Inflation, geopolitical instability continue to persist. We're seeing, geopolitical stuff that is impacting really every aspect of business, the tariffs and, the military conflicts, really all that's been happening. All of it has impact on the economics and the macroeconomic environment. And so we're looking at these factors and we're saying, okay, what does this mean for where we are? And what does this mean for us as investors? Well, one thing that we're looking at pretty closely is inflation, and just kind of asking ourselves the question, is inflation starting to stabilize? It does seem like that's the case. So really, if you look at inflation since mid 2022, inflation has kind of been trending downward and really stabilized. So we're seeing what we think is a little bit more of a stable inflation environment right around the Fed's 2% target. So, that's starting to give us a little bit of kind of belief that some of what has been unpredictable over the past few years is really starting to stabilize. And that's why, you could really make a guess of what's going to happen from here on out. But that's why we really like to focus on, okay, well, as things are leveling out here, what are really the principles that we need to stick to? What are the basics that we need to get back to? So let's talk a little bit about investing. And Josh, I know you like to talk about how does traditional investing kind of compare to alternative investing?
Yeah, for sure. So, yeah, let's look at that exact question. So, when you look at how most folks invest in a traditional standpoint, really heavy focus on the stock market with equities and bonds. So, traditional portfolio composition: 60% equities, 40% bonds. Tends to be more heavily weighted equities, kind of earlier in career, earlier in life, and then layering in a greater and greater allocation of bonds as folks progress through the decades and need more stability and more predictability. But just kind of rough benchmark: 60% equities, 40% bonds is what you'll see in a lot of mainstream portfolios. Alternatively, when you look at how the wealthy invest, and this is folks with a balance sheet of 20 million or greater, so considered an ultra high net worth investor, it looks completely different. We go from a really traditional kind of two bucket split to a pie chart with a lot of different categories. And we see that actually the number one asset into which the ultra wealthy are allocated is real estate. We see 26% in real estate, 25% into private equity, another alternative that for a lot of folks is just totally out of reach and not on the radar at all of most wealth managers of traditional portfolios. Then we see 22% in public equities, a heavy allocation to cash, and then some other alternatives like fixed income products, hedge funds, and some miscellaneous components of the portfolio. So a really different breakdown.
Yeah, and so one of the things we like to talk about are how do you avoid the wealth destroyers. So
Right.
Can you talk a little bit about some of those wealth destroyers, what you think they might be?
Yeah, and this is something else that we see. This is really firmly on the radar of ultra high net worth folks. It's not just about growing the balance sheet. It is about how do we protect and preserve wealth. It's about making sure that we're not eroding the capital base as opposed to just growing it as aggressively as possible. So really three things that we think about here and that we see sophisticated investors think about. First, of course, is principal investment loss. So these are market losses over time, which of course is going to reduce the overall outcome. If the products that you're invested in are going down in value, this is obviously destroying your wealth, and that's something that folks are taking into consideration. For the most people have this on their radar in some way, shape, or form. Secondly, is taxes, which everyone knows about taxes, of course, but when we see how the ultra high net worth individuals invest and think about wealth destroyers, they're thinking about their tax optimization strategy a lot more than a more run-of-the-mill portfolio would be thinking about. So even modest tax savings compounded over time can have just an enormous impact on lifetime net worth. If you can figure out how to get marginally more efficient in the tax component of your balance sheet and portfolio, it can really have tremendous compounding effects down the line.
Yeah.
And then thirdly is this concept of a black swan event. So this is an event that has enormous impact that by definition is unpredictable. So again, principles over predictions. You can't predict what a black swan event would be. This is something like 9/11 coming up was a black swan event, or Hurricane Katrina. You can't predict that is going to happen, but you can predict that in your lifetime there will be a black swan event. So we see sophisticated capital recognizing that unpredictable things with huge ramifications are going to happen, and they're thinking about constructing their portfolio in a way that they can weather a storm or even have some component of the portfolio that is anti-fragile and stands to benefit when there's a big systemic shock.
Yeah, and Joshua and I were talking about that book, Anti-Fragile, by the gentleman who came up with this concept of black swan event. And there's so much to learn there. Something we'd recommend if you're really interested in kind of geeking out on the specifics, maybe check that out. Given that backdrop, you want to really be thinking about, to your point, assembling a portfolio that is resilient and at a minimum, maybe anti-fragile at a best case scenario. Right. One of the things we talk about is low volatility and low correlation. So obviously we're biased, so I'm sharing a bit of a biased perspective here, but private real estate, which is what we do, for example, has the 20-year annualized standard deviation makes it lower in terms of volatility than public equities and public REITs. So, and that makes sense. Like the private market is just going to be less volatile. Like it's harder to get in and out of the private market. Therefore, it doesn't react as emotionally. And then similarly, low correlation, as you're looking at that pie chart of assembling a portfolio of diversified investments, you really want to be thinking about, if you assemble a portfolio and all those pieces of the pie chart are all correlated, you're not really doing what you're supposed to be doing from a diversification standpoint, because if they all go down, or if one goes down, they're all going down. So low volatility, low correlation is kind of what we look for when assembling a portfolio. And then it's really about the data. So we say here, trust the data. Don't trust the hype. Don't trust the news. Trust the data. And there's a reason for that. If you think about the principle of the data doesn't lie, whereas not that the news is intentionally trying to lie, but what ends up happening is people flood to what is happening in terms of hype and news, and then that particular investment gets flooded with capital and no longer becomes a good investment. You see this all the time, again, in public markets because they are more volatile. So you'll see, GameStop fly up, and it's like you look at the fundamentals and you're like, wait, there's not money here. Like this company's not actually making money, but people are emotionally kind of investing in it because they're sort of following the news. So what do we look for? Well, from just a real estate investing standpoint, we're using broker insights like CBRE, JLL, big picture data, AI forecasting. We're using a ton of machine learning, ton of ChatGPT, deep research to figure out what's happening in our markets, and pricing benchmarks. Just looking at, the asset versus market data to say, hey, is there alpha here that we can take advantage of? Where do you find that data? We're looking at demographics from local government offices, U.S. Census Bureau, CoStar and Yardi. There's lots of places you can go to find good data. The key is making sure that you actually do that. Like go look at the data, find good data, and rely on that. And when the data says not to invest, it does require a little bit of discipline, but you got to be ready to not invest. And frankly, that's something we've seen even over the past year as investors. We've slowed down a bit. Now we just had a nice investment, nice acquisition just last week, but you've seen a lot of investors kind of slow down their pace of investing. That's because there's a lot of uncertainty in the market, and that's okay. You want to really be thinking about what is going to be a good investment, making a good, wise, informed decision.
Absolutely. Yeah. So what else do we look at from a real estate standpoint? Again, as Andrew mentioned, we're speaking from our own industry. How do we think about data as opposed to hype? We're looking at a market level. We're looking at GDP growth. We're looking at things like demographic shifts, so migration patterns within the markets in which we're considering investments. We're paying attention not just to the gross number of in-migration and out-migration, but what is happening in terms of any kind of a shift on incomes within a demographic that might otherwise be stable from a net population growth standpoint. But digging into a shift within a stable population can really uncover alpha, like Andrew mentioned. And then at the property level, we're of course digging in from an individual asset standpoint on things like occupancy rates, what's going on at this property itself, what kind of new construction activity is there within the market, and does that bode well for the asset, or do we think that it's potentially competitive and detrimental to an acquisition that we're considering? We're looking at rental growth, both at the submarket level and at the asset level, to really understand what's going on with rents. And then, of course, cap rate trends. In our industry, the cap rate is really just a name for an unlevered yield. So we want to understand what is the return that folks are demanding who are professional investors from the kinds of assets that we buy, and what are those trending to over time to help us understand what things will look like over the life of our investment period. So again, these metrics help us to assess the health and the potential of different markets that we're considering as real estate investors. Another metric that we think is interesting right now as acquirers of multifamily assets is the cost of renting versus owning. Excuse me. So one of the things that we look at in a market is what are rents, and then what is the monthly cost of a mortgage. So we want to make sure there's a healthy spread between where rents are and what a mortgage would be, because again, as we're trying to determine what's the demand going to be for a multifamily property, if folks can go pay less for a mortgage on purchasing a house, that's a bit of a red flag. So one of the things that we're paying attention to and seeing now, we see these track nationally pretty closely to one another over time, with a bit of inversion around the 2010 Great Recession time period. But now we're seeing a huge spike in the cost of new purchase versus a lease, actually a 52% premium in the cost of ownership versus renting, which again is a piece of data that gives us tremendous confidence in investing in multifamily rental properties, because they are so much more affordable relative to the cost of home ownership.
Yeah. And, you talked a little bit about making sure that not only are you focused on principal investment losses, but also kind of tax efficiency. So I think there's a time to kind of take an offensive strategy and a time to take a defensive strategy. And, you want to make sure you're not losing principal. You also want to make sure that you're retaining as much of your capital as possible. So shifting gears a little bit, we're going to talk about tax efficiency. There's a few things that we've learned that can really, help benefit when investing in general, but specifically, again, our domain of expertise is really real estate. Accelerated depreciation. So new tax laws in the big beautiful bill are actually making this kind of even a little bit more efficient. But I would say that accelerated depreciation is something that you want to be thinking about, so you can accelerate to the early years of ownership, get good passive losses that you can then use to offset any passive income that you have within your portfolio. Second is tax deferred growth. So you're doing things like 1031 exchanges allow you to grow your capital on a tax deferred basis, and that alone can really amplify the impact of your capital. And then last, capital gains and estate planning, really thinking about, okay, when it is time to take some chips off the table, what can you be doing to pay long-term capital gains as opposed to short-term capital gains, and have a what's called a stepped-up basis. Caveat, we are not CPAs. Consult your CPA on this. But these are some like tools and tactics that we talk to our investors about to make sure that they're taking advantage of all of the tax benefits that are available. Again, when you're thinking about your asset allocation, to make sure that not only are you growing your asset base, but you're retaining as much of it as possible. And I'll just mention, again, not going to go through this in too much detail, but recent legislation changes. Bonus depreciation was extended, so 100% bonus depreciation for anything placed in service after January 2025. And I put on here 2029, but it's actually a little bit open-ended right now. It may actually stay open indefinitely. And then increased what's called Section 179 expensing. Again, not going to get into too much detail, but the threshold has changed from 2.4 million to 4 million, which again just allows you to take advantage of those tax benefits that are available to you.
Yeah, so some more core tools, like Andrew mentioned, a 1031 exchange. This basically allows folks that own real assets to defer paying capital gains taxes whenever they're selling that investment property. Some other things qualify for most folks in our world. It tends to be investment property. You can then reinvest those proceeds into a similar, what's called a like-kind investment property, essentially deferring taxes until the eventual sale of an asset. So rather than taking the capital gains haircut on your equity basis whenever you sell, if you use the proceeds to buy a like-kind investment property, you can roll all of the proceeds forward into that vehicle rather than, or into that asset rather than having to pay capital gains. Next is cost segregation. So this is what enables accelerated depreciation. So when you do a cost segregation study, you're essentially breaking a property into its component parts, like the foundation, the roofs, electrical, plumbing, for tax purposes. That, as Andrew mentioned, just allows for faster depreciation on select items, allowing you to take more of an upfront deduction to improve early year cash flows through this accelerated depreciation piece.
Yep, exactly. And just kind of last but not least, can you talk about, so there's a few what we call strategic enhancers. So that's like we covered the basics, right? You want to capitalize, use those kind of basics, take advantage of those. What are some of the strategic enhancers that you can do in addition to kind of the basics?
Yeah, absolutely. So the first one would just be, rather than selling an asset, you can do a cash out refinance. And you're leveraging the appreciated value of a property without having to sell. So you're pulling equity out and accessing that capital for new investments without triggering really any taxable event, because borrowed funds aren't treated as income. So the entire amount that you refinance out of an asset can be used for other purposes, totally tax-free. Next is an opportunity zone. We're getting this question more and more from investors. This is basically where the government designates an area that they view as economically distressed, where certain new investments are eligible for preferential tax treatment. Things like tax deferral on capital gains, a partial step up in basis, sometimes even the permanent exclusion of gains, because they want to incentivize investment in a particular area. So there are groups, and we're happy to make introductions to folks who have products that invest specifically in qualified opportunity zones that we think is a really an interesting opportunity. And then lastly, a step up in basis. So this is really an estate planning strategy to help with estate planning and leaving assets to one's inheritors. So upon inheritance, the cost basis of a property basically resets to its current market value. So that eliminates capital gains taxes on appreciation during the prior owner's lifetime, and that really helps to preserve more wealth for future generations and future planning.
Yeah, so those are some of the tax benefits and tax efficiency items that we're paying attention to. Also, some of the kind of portfolio allocation dynamics that we like to think about as it relates to making sure you're retaining as much of your capital and really prioritizing those principles of sound investment strategy over predictions in the marketplace. So we would love if you would connect with us on social. We're pretty active on LinkedIn. Please do feel free to reach out, ask any questions. It's a QR code on screen as well that you can grab. We do have maybe a couple minutes left. I see a few of you are online. Anybody online have any questions that you wanted to ask us? Right. Well, people are being shy online, but thank you all so much for joining. It's great being with you all virtually. If you have any questions, please do just reach out to us. We're happy to answer questions. Appreciate you coming along, and we will see you all next time.
Thanks, everyone.